Let's begin with this point about trade tensions. How much risk is there, Davide, for U.S. financials in the aggressive posture that President Trump has taken toward China and his pullback or apparent intent on pulling back from international agreements that has so annoyed the Europeans?
Well, there is high risk because remember, you have 40 years of global growth, which has been based on global trade, basically strengthening of international cooperation, agreement at central bank level on how to intervene, and if suddenly someone wakes up and screams and shouts and tries to change what ultimately has benefited the whole world over the last 40 years, there's going to be an adjustment phase. And you're probably going to see it in lower bond yields, which ultimately will reduce the profitability of banks short term, which means banks can lend less in the United States. And what could happen as inflation is picking up, because all these measures ultimately are inflationary in the US. Protectionism will increase inflation in the United States.
What about fund flows that benefit the most global banks, like JP Morgan and Citibank, for example?
Well, on fund flows here, the issue is it depends what's going to be the response of, let's say, global savers. Remember, the United States right now has a twin deficit. It's the country that is printing the more currency between fiscal and monetary around the world. You're looking at about 6% deficit. So you're talking about almost $1 trillion that needs to come in the States from foreigners in order to fund the economy. And what you could see is short-term flows might be beneficial to the US dollar, but long-term, to me, it's not clear. And that ultimately will damage even further the competitiveness of the US economy.
Do you think there's any risk that the Chinese would undertake some kind of retaliatory policy against US financial interests if these tensions between China and the United States heat up further?
Well, China has pegged its own currency to the US dollar. That does not make much sense, to be honest, because of the cycle which they are, the economic phase, the historical background. So basically, there's an agreement. I sell you goods, you buy my goods, and I buy your US Treasury. That's the deal. If Donald Trump only looks at one side of the equation, which says, I want to stop buying your goods, then the Chinese can say, well, perfect, I'm going to stop buying your dollars and your debt, and you finance it yourself.
And how close do you think we are to that happening?
I don't think we're that close, but eventually, in the state for tat, you never know what it's going to end up being. And ultimately, you could easily see a weaker dollar on a 12 to 18 months view, simply because the $1 trillion that needs to be financed can only be financed domestically, and domestic investor will require higher interest rates given where inflation is and 10-year yield are.
Davide, I want to ask you about Italy. Your funds had a rough month in May. Was that because of Italy alone?
I think it depends. As a firm, we actually did very well. Our equity strategy had more exposure to Italy. I think Italy took us by surprise, partly. It's a blip. I think the new finance minister, in my view, is a very solid person. It's beyond the populist rhetoric. And so I think Italy will be back on track. And we've already seen that the finance minister is basically proposing a finance bill to the European Commission, which is very much in continuity with what the former finance minister Padoan did over the last couple of years.
So Italian financials repriced more than 20% lower after May 15th. Yep. They've since rebounded a little bit, but they're down 16%. Is that the right level?
I think it's a right level given the uncertainty, but I think there is value in them. And the reason is because the reprice of the, let's say, the 2-year Treasury yield in Italy and the 10-year, in my view, are overdone.
So if there's value,
yep.
Are you increasing your positions?
Yeah, we've been increasing our position since the sell-off.
Since the sell-off?
Yep.
So Italian financials, if you're in your equity strategy, Italian financials make up what percentage
equity
now?
Strategy in our Italian, overall, they make about 10%, which is a big overweight, given their GDP weight is about 2%.
And where were they before the sell-off?
Before the sell-off, across Europe, we had about 60-70% across Europe. We reduced it to 30. So let's say European banks were down around 25%. Year to date, we're down less than 3%. So I would say doing very well in relative. And I think right now where European financials are with the index at around 115. To give you an historical perspective, the lows were 70 at the low of the crisis in 09 and in 11. The high used to be 600 pre-Lehman. At 110, I think they offer very good value, assuming rates will rise.
Davide, how about Deutsche Bank? You have said that Deutsche Bank equity and credit were uninvestable so long as management was committed to U.S. investment banking. It appears that the new CEO, Christian Sewing, is doing exactly what you wanted, withdrawing from U.S. investment banking. Still uninvestable?
Well, I think now the course of action is the right one. Here, the question now need to see execution and implementation. We need to see in the numbers how fast they can cut from the US to shore up revenue, cost, and capital in the core part of the business. I think the first decision taken by the CEOs are very positive. I think they were aligned to what the former CEO, John Crine, wanted to do. So now it's about execution. Direction is right. Speed and execution will tell.
Are you buying yet?
Not yet, because I want to see numbers first.
Now, when you said uninvestable, did you mean that there was no growth for the equity?
No, I think there was lack of underlying strategy, and what you could end up having is a financial that makes no money. So the key problem of Deutsche Bank over the last 20 years is it doesn't make any money. So it's solvent, it's stable, it just doesn't make any money.
If it's solvent and stable, then why is the credit uninvestable?
The credit is not uninvestable. The problem is when a bank stalls because it doesn't make any money, then people question the sustainability of it. And then inevitably the cost of funding rises, and because it's a highly levered institution, then suddenly the profit shrinks. So the two are interconnected, which might well be that eventually they need to buy the bullet and shrink faster. That's the only option they have.
It's cut their way to success.
Yes.
Let me ask you about the macro backdrop. We've already established a couple of things. Clearly, there's a lot of trade tension. Here in the United States, you have short-term interest rates rising for the time being. You have the yield curve flattening. You have the credit cycle nearing its inevitable end. And in Europe, you have the ECB beginning to withdraw stimulus and people anticipating a rate hike in 2019. With that as the backdrop, what in the financial world is attractive?
So with this backdrop, I think what is attractive are very strong US financial, means they have a competitive edge, strong brand, global diversification, and they're posting a return on equity around 10%, because they're basically, no matter what, they'll keep on printing numbers. And when I think of the equivalent in Europe, which are 3-4 years behind where the US cycle is, which will benefit eventually out of interest rates normalization. That will happen sometimes between 19 and 2020.
So let's name some names. Here in the United States, what's attractive and what's good? What appeals to you in Europe?
So in the United States, what we find very attractive are the alternative space, so the Blackstone, the Apollo, because they're generating an 8-9% free cash flow yield, but because they're not incorporated as a normal C Corp, ETFs and passive investors can't buy them, so we love them, because I think they can only benefit out of the next cycle, and plus you get paid an 8-9% free cash flow yield to wait. So even if you don't like the movie, they still pay you 8-9%. Secondly, in Europe, we like the company with exposure to rising rates, and basically what had happened in the US that we think will happen in Europe. So we're talking about Santander, we're talking about Intesa, we're talking about UniCredit, Societe Generale, BNP, and Credit Suisse.
And in the credit world?
In the credit world, what we like a lot is Europe. And to give you an idea, today, apple for apple, same credit risk across the 60 largest financial institutions in the world. In the States, you're paid 3-4% in dollars. In Europe, in dollars, you're paid 7-8%, which is very attractive for the same risk. And so I think from a dollar perspective, you'll be better off taking European credit risk denominated in dollar. It pays you almost twice as much.
Why is that European risk underpriced?
European risk is underpriced because it's seen as complex from the US investor. And remember, made 100 the money managed in the world, 80% has an Anglo-Saxon hat. And hence, they would always feel more comfortable at home rather than going on holiday. They like to go on holiday, but not with the money.
And that explains it.
Exactly.